This is the Commercial Real Estate Insights Podcast. I'm Steve Hamoen, and it is 10 o'clock in the morning on Friday, April 4th. Here's what we're covering today. Multifamily cap rates in Texas are looking steady, maybe too steady? Disposable income versus rent is a bigger story than cap rates alone, and what the latest migration and job data tell us about which cities are under or overperforming. And in other news, Austin's got 30,000 new units underway. What does that mean for the 14% vacancy they're already facing? First, let's talk cap rates. From what I'm seeing as an outsider peering into the Texas multifamily market, cap rates across Dallas, Austin, and San Antonio are surprisingly consistent. Right around 5.18% to 6.85% depending on property class. Now, to me, that's curious. Dallas is sitting on a 10.8% vacancy rate. Austin's even higher at 14%, while San Antonio's holding a more stable 90% occupancy. Yet their cap rates are identical. That seems off unless we're looking at a broader investor psychology driving pricing more than local fundamentals. If you're a boots-on-the-ground investor or operator in one of these cities, I'd love your take. Does this reflect reality, or is it a lag in pricing catching up to local trends? Next up, let's unpack tenant affordability. Disposable income after housing, taxes, and debt is arguably the metric that matters most for sustainable rent growth. In Dallas, a single person renting has about $37,759 left each year. That drops to just under $31,000 if they're paying a mortgage. Austin looks better, $45,000 left after rent, but only $27,000 post-mortgage. San Antonio? Only $21,000 left after rent, and just $9,000 after mortgage. For me, that raises red flags. Because even though San Antonio has great occupancy, are renters really in a strong enough position to drive future rent growth without heavier concessions? That 185% spike in landlord incentives last year in San Antonio makes a lot more sense when you pair it with these affordability stats. Now, shifting gears a bit, let's zoom out and look at migration and job stability. Texas as a whole continues to attract people, but the where within Texas matters. In 2024, San Antonio pulled in around 50,000 new domestic residents and had a net positive migration balance. Dallas, by contrast, had 20,000 people move in, but lost 35,000, so a net loss. Austin's story is even more nuanced. 38,000 domestic arrivals, but 67,000 departures, likely to the suburbs or more affordable metros. On the employment front, Austin's still a tech juggernaut, but last year they saw a 1.4% labor market decline. Meanwhile, Dallas added 1,800 new jobs across sectors like logistics and professional services. San Antonio saw growth tied to healthcare and manufacturing, boosted by I-35 corridor activity. From where I sit, Dallas looks like the most balanced market, even with its vacancy issues. It's adding jobs, has decent income-to-rent ratios, and migration may be stabilizing. Austin has long-term promise, but short-term oversupply and affordability could be a challenge. San Antonio feels like a value play, but the margin for error is thin. So here's my ask to the local experts. What are you seeing that the data might not be capturing? Are rents really holding up in Austin despite negative rent growth? Is San Antonio's job base sticky enough to support another 15,000 plus units coming online? And is Dallas quietly becoming the stealth winner just by being steady? I'm running numbers, but you're running properties. I'd love to hear your ground truth. That's all for now, but we'll be back tomorrow. Don't forget to hit follow or subscribe and leave a review to help others discover the show. I'm Steve Hamoen. Until next time.